Following what proved to be a very busy first half to the year in 2019 and a summer season that saw continued momentum across all sectors of the Irish commercial property market, the autumn selling season has now formally commenced. The occupier sectors of the market remain robust, despite growing concerns about the global economy and the possibility of a no-deal Brexit, which has heightened since the election of Boris Johnson as the UK Prime Minister in July. The property sector will undoubtedly be on alert over the next 2 months to determine what implications Brexit and indeed Ireland's forthcoming budget on the 8th of October will have for the economy and in turn the property sector. As the autumn season commences, agents across all sectors of the market are confident about prospects for the rest of the year, but all are expressing frustration at the backlog of transactions that are currently waiting completion at present. This has been attributed to delays in legals and also the complexity of some of the transactions that are underway in various sectors of the market which take longer. Following a busy first half to the year, during which more than 150,000 square metres of office leasing activity was recorded in Dublin, the market paused for breath during August. This is symptomatic of the time of year, but also reflects the complexity of some of the larger transactions and pre-lettings that are underway in the market, which take some time to transact. With only 4 months left in 2019 and Brexit uncertainty expected to heighten further over the coming weeks and months, it remains to be seen how many of these sizable office transactions will complete before year end and which will fall into Q1 2020. In addition to many outstanding mandates, a number of new requirements have materialised in recent months, which is encouraging. But with a good volume of fitted suites, serviced accommodation and indeed co-working options available for occupiers to satisfy requirements in the short term, there's less pressure on occupiers at the moment to make longer term accommodation decisions. That said, speculative office buildings that are under construction are generating considerable interest from potential occupiers once practical completion is in sight. More than 170,000 square metres of leasing activity was recorded in the Dublin industrial and logistics market during the first half of the year, up almost 60% on the same period last year. This was boosted to some degree by an increase in Brexit-related activity. Momentum continued throughout the summer months. Demand for light industrial buildings has increased noticeably over the last couple of months, and a number of sizable new requirements have materialised, which again is encouraging. In addition to ongoing sale and leasing of industrial and logistics buildings, we have noticed an increase in activity in the industrial land market in the last couple of months, with several acquisitions underway off-market, including a number in the data centre sector. Dublin Port recently obtained planning permission for the latest phase of inland development near Dublin Airport, freeing up valuable space at Dublin Port. Brexit uncertainty will heighten over the coming weeks as the 31st of October deadline looms ever closer. Interestingly, the industrial and logistics sector of the Irish market looks likely to see increased demand regardless of the ultimate outcome. The average vacancy rate in 34 of the most modern and industrial and logistics parks in Dublin was 8.37% at the end of Q2 2019. This is expected to decline further over the coming months on the back of current activity levels and the dearth of new supply under construction in this sector of the market. Prime industrial rents remain stable as the autumn season commences. The uncertain outlook on Brexit is skewing Irish consumer sentiment and causing some retailers to put off decision making at present. As the seasons shift and retailers gear up for the autumn trading season, there's continued activity in the retail property market, although, like in many other sectors, the length of time it is taking to get transactions across the line continues to frustrate. Much of the activity on the retail market at present is heavily concentrated in the convenience, food and beverage, service and leisure sectors, and that is evident from recent transactions. with retailers increasingly willing to hold off indefinitely on making location decisions until the right retail unit comes available, we expect considerable appetite for some of the units that are likely to come to the market in the coming weeks. In line with some weakening of retail yields, which has occurred across many markets across Europe during the first half of 2019, there has been some softening in high street retail rents experienced in some locations, including Dublin, over recent months. Prime rents on Dublin's Grafton Street are now trending at approximately €6,250 per square metre on a Zone A basis, while prime rents on Henry Street are trending at approximately €4,000 per square metre on a Zone A basis. Supply remains tight on both streets, however, with the most recent vacancy counts showing a vacancy rate of only 4.4% on Grafton Street and 2.1% on Henry Street at the beginning of Q3. In addition to several sizable investment transactions that are at various stages of negotiation or legals in the Irish market at present, the completion of the recently announced Green REIT plc sale to the new entrant Henderson Park for €1.34 billion later this year will provide a significant boost to investment spend in what has already been a busy year, with almost €2.1 billion of investment assets having traded in the first half of the year. Considering the strength of underlying occupier activity, investor sentiment remains very positive, with appetite heightened by the significant yield premium that Irish real estate currently offers compared to other forms of investment, particularly taking anticipated interest rate changes into account and indeed recent government bond movements. The depth of buyers for retail assets is clearly thinner than it was 12 months ago, but vendors' expectations are realigning, and where pricing is sensible, we continue to see buyers selectively looking at assets in the retail sector. The bulk of investor demand is, however, focused on offices, industrial and the residential sector, where rental growths are clearly better. There's particularly strong depth to investor appetite for lot sizes ranging between €20 million and €50 million at present, and good demand for smaller lot sizes too, if they are priced appropriately. The buyer profile for large lot sizes of over €100 million is somewhat different, with strong Asian appetite continuing to prevail, although the complexity of some of these transactions is adding significantly to the length of time it has taken to complete the transactions. With the exception of some further softening in retail yields over recent months, prime yields in all other sectors of the Irish investment market remain stable as the autumn season commences. 43% of investment spend in Ireland during the first half of 2019 comprised residential properties, with Dublin included in the top 10 European destinations for cross-border multifamily investment in the period. In total, more than €898 million was spent on residential investment transactions in Ireland during the first 6 months of the year, a figure that is likely to be exceeded in the second half as several large trades are completed both on and off market. Unlike other sectors where activity slowed a little bit during the summer months, activity in the Irish build-to-rent sector continued unabated throughout July and August, as various investors, promoters and operating platforms continue to look for opportunities to align themselves with developers and deploy capital into what is essentially a supply-starved market, particularly in Dublin. Recent transactions bring the number of residential units under institutional ownership in Ireland to approximately 11,700, up 25% year on year, with 15 institutional owners now active in the Irish market. For some time now, we've expected to see different iterations of residential accommodation solutions emerging in Ireland. In this respect, the recent grant of planning permission for Ireland's first purpose-built co-living scheme is noteworthy. The 208-bedroom scheme in Dún Laoghaire in South Dublin is expected to lead to further applications being lodged for co-living and micro-living concepts from this point forward. With several new rent pressure zones announced in recent months, more than 2/3 of Irish residential tenancies are now controlled by rental caps of 4% per annum. The Residential Tenancies Board recently provided better clarity on what constitutes substantial refurbishment in order to obtain exemptions from these rental caps, And this guidance has been helpful in clearing up ambiguity for both landlords and tenants. We continue to see planning applications being lodged and indeed granted for new schemes in the Dublin market. And as viability improves further in regional locations, we expect to see some more purpose-built build-to-rent stock starting to come on stream and being proposed outside of the core Dublin market in due course. 30 land sales were completed in Ireland in the year to the end of June, totalling more than €415 million between them. Following a somewhat quieter transactional period during the summer months, several site sales are now nearing completion, and this will boost spend and create new price evidence in due course. There's been increasing evidence of price stabilisation in the development land market over recent months as developers react to a combination of easing house price inflation, affordability issues and rising bill cost inflation. There's particularly strong demand for sites up to €5 million in value, and a busy H2 is now in prospect as some new sites are formally launched for sale. However, with most of the land that's coming to the market and transacting comprising relatively small infill sites, the overall spend on development land in Ireland is likely to be down year on year, albeit consistent with the volume that would have traded between 2014 and 2017. One large transaction that will dominate headlines over the coming months, however, is the Glass Bottle site, where bids are due on the 10th of October. This site was offered to the market in recent weeks, guiding €125 million. The industry is naturally concerned about mooted changes to the Help to Buy scheme in the forthcoming budget, on the basis that any tampering with the system, which has been instrumental in helping to increase new home delivery over the last 2 years, could stymie the delivery of much needed supply, particularly in the Greater Dublin area where supply shortages are most acute. The volume of tourists visiting Ireland in the first half of 2019 reached a new record of over 5 million visitors. This is up 3.6% year on year, with strong US and Canadian visitor numbers recorded due to an increase in transatlantic flights and I suppose the relative strength of the US dollar, offsetting a deterioration in UK visitor numbers, which have declined as a result of Brexit uncertainty and weakening sterling. Dublin Airport had its busiest month ever in its 79-year history in July, with almost 3.9 million passengers recorded in the month. The hotel and tourism sector got a further welcome boost from the announcement in recent weeks that Ireland has won a bid to host the Ryder Cup in Adare Manor in 2026. From a transactional viewpoint, demand continues to outstrip supply in the hotel sector, particularly in Dublin city centre, although there has been somewhat of a plateauing in hotel performance in the city of late, which is probably attributable to the impact of last year's hike in VAT and the fact that new hotel supply has finally started to come on stream. In addition, several of the new student accommodation residences that have been developed over the last couple of years have been let to tourists during the summer months, and this is alleviating pressures in the hotel sector. Changes which came into effect in July regarding the short-term letting of residents on sites such as Airbnb don't appear to have had a discernible impact on the hotel sector as yet. There was almost 206 million of hotel transactions recorded in 12 individual sales in the first half of the year. This isn't representative of underlying activity, however, with several large hotel transactions currently at various stages of negotiations and legals, including some sizable Dublin properties which have the potential to boost H2 transactions. In fact, there's up to 500 million of hotel transactions which have the potential to complete in the Irish market before year end. In addition to traditional hotels, we are increasingly seeing investment appetite to forward fund properties that will be leased and operated by hoteliers and hotel chains. There's been considerable activity in the Dublin pub market during the summer months, which will provide a welcome boost to activity in this sector in the coming months as these transactions ultimately complete. Several Dublin pubs, including Quinn's and the Cat and Cage in Drumcondra, the Leeson Lounge in Dublin 2, the Concord in Raheny, the Copper Bar in Sandyford, Uncle Tom's Cabin in Dundrum and the Magpie Inn in Dalkey are all now at legals. There has been a discernible increase in investor demand for nursing homes and primary care centres in the Irish market in the last couple of months, mirroring a trend that's been experienced throughout Europe as investors, encouraged by demographic changes, seek to source investment opportunities in alternative sectors such as healthcare. Many investors in the healthcare sector seek to undertake sale and leasebacks or to purchase operational nursing homes with a view to ultimately creating long-term leases to specialist operators. In some cases, they're looking to develop new facilities, with new builds offering an opportunity to create operational efficiencies and help them ensure compliance with ever-tightening regulations. However, with each nursing home bed costing between €160,000 and €165,000 to develop, the viability of many proposed schemes remains challenged. With nursing homes in Dublin and the surrounding counties being awarded the highest fair deal rates in the country, investors are obviously primarily attracted to purchasing and developing facilities in the Greater Dublin region. Almost all of the transactions that are occurring in this sector of the market are occurring off-market, making it a difficult market for investors to navigate. However, investors are sourcing opportunities, and in the relatively recent past, the ownership of several of the largest nursing home groups in Ireland has transformed, with French, German and Dutch investors now owning many of the larger nursing home facilities. In keeping with the time of year, transactional activity was relatively subdued in the Cork market during the months of July and August, although negotiations are ongoing on several transactions, including office leasing transactions and land sales, which will hopefully come to fruition over the coming months. Most of the activity in the Cork market in the last couple of months has been focused on planning and development, with construction continuing at pace on several projects in the city and planning lodged or in the process of being lodged on a number of new schemes. As the autumn season commences, we're facing a very interesting couple of months politically and economically. However, despite all of the noise about Brexit, the budget, trade wars and global economic slowdown, the prospects for the Irish commercial property market still look promising. Recent guidance from the Federal Reserve and the European Central Bank suggests that interest rates are now likely to remain low for a longer period of time than originally anticipated, which in turn bodes well for continued investment in the real estate asset class, where income returns look attractive in relative terms, particularly in light of recent government bond movements. To download our full bi-monthly report, please visit the newsroom of our CBRE Ireland website at news.cbre.ie.